Good afternoon, everyone. The topic this week is the US and China trade war and the impacts on Asian commercial real estate. Despite active interest in outbound capital, trade tensions have affected capital flows both in and out of Asia, while intra-Asian capital still looks firm. Here to share more on these topics with us is Andrew Haskins, Executive Director of Research for Asia Pacific from Colliers. Over to you, Andrew.
Thank you very much, Stephanie. And ladies and gentlemen, thank you for joining this meeting. As was mentioned, my name is Andrew Haskins, Head of Asia Research for Colliers International. This presentation summarizes or explains our views about the impact of the US-China trade war on commercial property markets. It will take 15 minutes or so to go through. I know that there are no questions on this call, but please come to us later should you have any questions. At any rate, let's get started. And let's summarize. Let's try to summarize everything right at the beginning. In terms of economic impact, both the US and China will be affected by the trade war, although Chinese GDP will probably be hit harder. The trade war will hit, in fact, already is hitting property capital flows between regions. I think really the crux of the presentation is that trade tension will impact Asian occupier confidence. And there are three things to highlight. South China will initially feel a greater impact due to its focus on technology. But East China, that is to say Shanghai and Beijing and North China, also face delayed leasing demand and rising vacancy. Hong Kong, which of course politically is part of China, faces various problems. The top multinational corporate occupancy, I want to explain why that's a problem shortly, but also ongoing protests and pressures on the finance sector. And against this sort of background, it's reasonable for occupiers to consider expansion outside Greater China to mitigate risk. And we will mention some possible destinations. Let's just talk now about the economic aspects of the trade war. Last year, 2018, according to the International Monetary Fund, $601 billion in trade flowed between the US and China, but the trade flows were very uneven. China exported $481 billion of goods to the US, but the US only exported $120 billion of goods to China. In the opinion of the US, the current US administration, the trade flows have been in balance for many years, and this is a problem which needs to be rectified. In the opinion of China, the surplus in China-US trade volume indicates the high complementarity of the two economies. In simple terms, China sells a lot to the US because the US wants to buy the goods that China produces. What is the present situation now regarding tariffs? The situation is complicated, but to try to state it as simply as possible, since May of this year, a tariff of 25% has applied to $250 billion of Chinese imports into the US. In simple terms, that's about half of all Chinese imports. The US is due to raise that 25% rate to 30% and to apply tariffs to many other Chinese imports worth up to about $300 billion in total by the end of this year. Now, if this happens, or if the trade war really escalates in this way, the opinion of most economists is that GDP, gross domestic product, will be materially affected in both the US and in China, although the US will be hit less than China will. Now, you could say that the trade war has been going on for about a year already. And that explains why the trade war already seems to be having an impact on property capital flows. This chart shows Asia to global, global to Asia, and intra-Asian capital flows within the property sector. The dark blue is Asia to global. And if you look at 2016 and 2017, Asia to global flows were strong because of heavy Chinese investment in the US. Now, last year, that really declined, and that decline has continued into 2019, mainly because Chinese investment in the US has really dried up. The light blue is global to Asia investment, which after many years of relative weakness really picked up in 2018, but has weakened again. The dark gray is intra-Asian capital flows, which have continued to increase. And it's perhaps easiest to illustrate the situation in the first half of 2019 on a separate slide, which I do here. You can see Asia to global flows fell 33% in the first half of the year. Global to Asia flows fell 28%, a very low level, but intra-Asian flows were up 3% to $54 billion. So intra-Asian flows have been less affected by the trade war. But what about the impact on occupiers? And at this point, we should just step back a little bit and mention the cities which we, Colliers International, see as the top locations for multinational occupiers in Asia. Last year, we published a series of research reports called Top Locations. We looked at finance, the largest sector. We looked at technology, the fastest growing. And we looked at law, a smaller but important sector, particularly in CBDs. And we looked altogether at 60 criteria spread across 3 groups of factors: socioeconomic factors, property factors, and human factors, and assigned each of 16 cities a score on each of those 60 measures, added them up, and then aggregated them across sectors. And it was our conclusion that Hong Kong is the #1 location in Asia, followed by Singapore, followed by Tokyo, followed by Shanghai. And these are really how we see occupier locations on a 2 to 5 year view. And the trade war, although it is material affecting some of these cities on a 1 to 2 year view, doesn't really change their position on a 2 to 5 year view. Hong Kong, Singapore, Tokyo, Shanghai all have strengths which the trade war will not change. But the trade war is having an impact in the near term. And there are 3 points to highlight. Firstly, a probable near-term reduction in confidence among technology groups in South China. Secondly, reduced confidence among multinational corporate occupiers in Greater China in general. And thirdly, tougher conditions for financial occupiers in Hong Kong in particular. And let's just talk about those in turn. South China has the highest degree of trade interconnection with the United States due to the importance of the technology sector in South China. Shenzhen is China's undoubted technology capital. Now, The trade war has already fed through to delayed leasing demand in Shenzhen, which is compounding the impact of substantial new supply. And as a result, we believe that the vacancy rate will rise by over 5 percentage points this year to just under 25%. And rents will probably fall by about 3% for the year as a whole. So right now, Shenzhen is under pressure. That doesn't change the fact that we see the city as a very attractive location for technology occupiers, number 3 for tech occupiers in Asia, according to our top locations research. That's after Bangalore and Singapore. What about reduction in multinational corporate confidence in China in general? Well, here it's worth highlighting that South China, despite whatever near-term issues it faces, isn't actually home to that many multinational companies. Shenzhen has about 15% multinational corporate occupancy of grade A office space. For Guangzhou, the figure is only about 10%. In contrast, for Shanghai, we think the figure is 31%, for Beijing, 40%, and for Hong Kong, 60%. And it's multinational corporate occupiers which perhaps may say, in the light of the present circumstances, in the light of the trade war, should we refrain from further expansion within Greater China? And probably the city most exposed to that sort of thinking is Hong Kong, due to the fact that it has the highest reliance on MNC occupiers and also pressures on finance. But before we talk about Hong Kong, let's just talk about Shanghai. Colliers office brokers believe that up to 1/3 of office leasing volume this year could be delayed by uncertainty linked to trade tensions. And this explains why we drop in net absorption this year. Is there a problem? There's something music. I don't know, somebody needs to put something on mute. Thank you. And there is also heavy new supply, particularly in the decentralized areas. We actually see total new supply of just over 2 million square meters this year, nearly 3 times net absorption. In consequence, we think that vacancy will jump about 8 percentage points to 22% this year. This is for the city as a whole, CBD plus DBD. Rents will probably drop about 5% this year before flattening next year and in 2021. Beijing is also under pressure, but to a lesser extent. But perhaps the city to highlight is Hong Kong. Among Asia's leading financial centers, Hong Kong has the closest correlation between the level of the stock market and grade A office rents. And this high correlation reflects the fact that, in simple terms, financial stocks represent 50% of the Hang Seng Equity Index, and financial tenants occupy 50% of grade A office space in the CBD. For Hong Kong Central, we are now predicting, given the substantial pressures that financial occupiers continue to face, I'm sure you've read about continuing redundancies, given the pressures that they face, we are now expecting rent to fall 4% this year and 13% next year in Hong Kong Central. And for Hong Kong as a whole, those figures will be more like 1% and 8%. Now, we're not saying, just to make this clear, we're not saying that companies in Hong Kong or Shanghai should pack up their bags. We explained that Hong Kong is the #1 location in Asia, in our opinion, Shanghai number 3. But given the trade war, it's reasonable for large companies to consider perhaps alternative locations for expansion in order to mitigate risk. What might those locations be? Finance, professional services, high-value technology groups will naturally consider Singapore, Hong Kong's perennial rival as Asia's most international city, offering high political stability, high availability of talent, and Asia's clear top position on quality of life factors. Large financial companies may also think again about Tokyo, Asia's largest and wealthiest city, and by far its largest office market. Total office stock in Tokyo is 7 to 8 times the level of Singapore, and it has a rising reputation for quality of life. Southeast Asia, in particular Vietnam, has benefited already from migration of manufacturing and trading groups out of China into low-cost markets. This trend is receiving added impetus from the trade war. And finally, India, attractive for larger occupiers, particularly technology-related companies. Colliers ranks Bangalore as Asia's #1 location for tech occupiers, ahead of Singapore and ahead of Shenzhen, while Hyderabad is a fast-growing alternative to Bangalore, also in southern India. And that, ladies and gentlemen, concludes my presentation. Thank you very much for listening. Thank you to the ULI for hosting this call. I know there are no questions permitted on the call right now, but if you do have any questions, please just get in touch with us afterwards. Thank you very much.
Thank you, Andrew, for your time, and thank you everyone for joining us. As mentioned, this presentation is part of our Thought Leadership webinar series, an exclusive opportunity for our corporate members to share thought leadership. Contact us to learn more. The presentation was recorded and will be available on our website. If you have any additional questions, please feel free to contact us. Thank you very much. Have a great day.